reckoning with a crisis born in silence. It did not begin with headlines or crowded bank lobbies. It began with quiet signatures on documents no one outside a handful of offices would ever read. Contracts layered upon contracts, promises stacked on top of older promises, all tied together by the belief that risk could be hidden, sliced, and sold without consequence. To understand why this crisis still haunts the modern system, we need to return to an America that believed it had outgrown its past mistakes. The old panics were studied, the old failures dissected, and new safeguards built with careful pride. Banks appeared stronger. Data seemed sharper. Models claimed to turn uncertainty into something measurable and safe. Growth felt disciplined, almost scientific. Yet beneath that confidence, a more complex story was unfolding. In search of higher returns, institutions began to move beyond traditional lending. Loans were bundled into products whose names sounded technical and reassuring. Layers of distance separated the person signing a mortgage from the investor buying a sliver of that debt on the other side of the country. On paper, everything looked efficient. Risk was spread, diversified, transformed into numbers that fit neatly into charts. But each transformation made the system harder to see clearly. Executives looked at aggregated figures instead of individual borrowers. Regulators stare at balance sheets that seemed healthy, unaware of the unstable structures hiding just beyond the margins. Even insiders who sensed something troubling struggled to explain it. The danger was not a single reckless decision. It was the quiet accumulation of thousands of decisions that all assumed someone else was watching the foundation. For everyday people, the shift felt invisible. Mortgages became easier to obtain. Credit lines expanded. New neighborhoods rose almost overnight on land that had been empty only a few years earlier. Families moved into homes that once seemed out of reach. To them, the system appeared generous, flexible, almost welcoming. Few realized that their signatures were feeding a machine no one fully understood. Inside trading rooms and corporate suites, the mood was confident. Spreads looked favorable. Defaults appeared manageable. Historical data suggested the models were correct. The profits seemed to prove it. Every quarterly report that exceeded expectations pushed the doubts a little further away. The silence around the real risks grew thicker, reinforced by bonuses, promotions, and accompanying belief that this time, finally, the system had mastered volatility. Yet beneath the surface, small fractures were already forming. Delinquencies ticked upward in overlooked corners of the market. A handful of analysts questioned the numbers, others accepted without hesitation. Their warnings sounded cautious, even old-fashioned, in a world convinced that technology and diversification had rewritten the rules. The crisis was not loud yet. It was gathering in the background, waiting for the moment when the silence would finally break. The quiet fractures within the system widened as the first waves of trouble began to surface. Delinquencies no longer looked like statistical noise. They formed patterns that analysts could no longer ignore. Entire neighborhoods saw rising defaults. Mortgage payments slipped behind schedule in regions once considered stable. Yet the true danger lay not in these misses themselves, but in how deeply they were woven into the financial machinery above them. Executives reviewed reports with growing unease. Models that once offered clarity now delivered contradictions. Risk projections drifted upward in ways no one could easily explain. Some managers urged caution, recommending reduced exposure or tighter lending standards. Others argued that the downturn was temporary, a minor deviation in an otherwise reliable trajectory. Their confidence felt persuasive, until it didn't. In the secondary markets where loans were bundled and traded, the mood shifted. Buyers became selective. Prices softened. Instruments once praised for their innovation began to look opaque and difficult to value. Traders struggled to agree on what these assets were truly worth. Without clear pricing, the foundations of the entire structure wobbled. Institutions that had bet heavily on these products found themselves holding portfolios they could neither sell nor accurately assess. Meanwhile, on the ground, the effects spread. Homeowners faced rising interest rates on adjustable mortgages. Those who had stretched their finances began to slip behind. Families that believed they were stepping into stability instead faced mounting anxiety. Entire communities felt the pressure as foreclosures multiplied, property values dipped, and support systems strained under the weight of unmet expectations. News outlets started to notice the trend. Articles questioning the health of the housing market filled more column inches. Analysts appeared on television offering cautious but unsettling statements. Some blamed predatory lending. Others pointed to broader economic shifts. But none yet grasped the full scope of the unfolding crisis. How deeply interconnected these loans were with institutions far removed from the people struggling to make their monthly payments. Inside regulatory offices, alarms began to sound. Staff members flagged irregularities in lending practices and raised concerns about leverage levels at certain firms. But oversight frameworks were not built for the complexity of these structures. Each warning felt incomplete, addressing only one piece of a puzzle no single agency could see in full. The crisis was spreading horizontally and vertically through the system, but remained invisible to those looking only at isolated indicators. Financial markets reacted with increasing volatility. Investors shifted positions rapidly, moving away from mortgage-backed assets and into safer instruments. The shift drained liquidity from sectors that depended on steady flows of capital. Institutions that relied on short-term funding felt the squeeze first, forced to scramble for cash as lenders demanded higher collateral or withdrew entirely. Stability, once taken for granted, now felt conditional and fragile. Still, many insisted the system was fundamentally sound. They argued that diversification would prevent widespread collapse, that losses would remain contained. Their confidence slowed the response, even as the data suggested a deeper reckoning ahead. The silence that had allowed the crisis to grow unchecked was now breaking. But the consequences of that silence were only beginning to reveal themselves. The tension that had simmered beneath the surface finally erupted as the crisis moved from isolated strain to full systemic conflict. What began as scattered defaults and uneven markets now revealed itself as a deeply rooted instability woven through nearly every layer of modern finance. The silence that had once concealed the danger shattered, replaced by a chorus of alarm from institutions, regulators, and citizens who suddenly realized the scale of what had been building for years. Banks that had confidently expanded their mortgage portfolios now faced a frightening truth. The assets they held were worth far less than their balance sheets claimed. Executives who had trusted models and forecasts were forced into emergency meetings, poring over numbers that no longer made sense. Some urged immediate write-downs. Others refused, hoping conditions would stabilize before panic spread. But the window for quiet correction had already closed. Liquidity dried up with breathtaking speed. Institutions that relied on short-term funding found the doors suddenly shut. Lenders who once offered credit with ease now demanded impossible terms, or withdrew entirely. Firms scrambled to unload the very mortgage-backed securities they had embraced for years, only to discover there were few willing buyers. Markets seized. Prices collapsed, and confidence, the one element holding everything together, slipped beyond recovery. On trading floors, the atmosphere turned electric with fear. Screens flickered with plunging valuations. Phone lines buzzed with urgency as brokers begged for bids that never came. Instruments once celebrated as innovations were now seen as traps, spreading losses across institutions that had never expected to be entangled in the housing market. The financial web that promised diversification had instead ensured contagion. Beyond Wall Street, the consequences were immediate and personal. Families already struggling with rising mortgage payments now watched foreclosure notices arrive in waves. Entire neighborhoods emptied as homes were abandoned or seized. Local businesses suffered as spending evaporated. Cities faced shrinking tax bases and rising needs, forced to confront crises they had no resources to manage. The economic shock, born in boardrooms and trading systems, now cascaded into the daily lives of millions. Regulators, alerted too late, scrambled to assess the damage. Reports flowed in from every direction. Failing institutions, collapsing funds, evaporating liquidity. No single agency could piece together the full picture. Hearings erupted into arguments. Blame shifted rapidly between lenders, investors, rating agencies, and policymakers. Everyone pointed to someone else's decision as the spark, but the truth was harder and heavier. The crisis had grown because the system had allowed silence to replace scrutiny. As fear spread, even the strongest institutions felt the strain. Banks, once considered pillars of stability, watched their stocks freefall. Foreign markets reacted sharply, sending tremors through global exchanges. Allies demanded clarity. Competitors demanded reassurance. But answers were scarce, and certainty was scarce still. In living rooms, workplaces, and city squares, the crisis became impossible to ignore. The belief that modern finance had become nearly invulnerable dissolved in real time, revealing a system far more delicate than anyone had admitted. The conflict reached its full height, not through a single collapse, but through the realization that the structure had been eroding long before anyone dared to look closely. The nation stood on the edge of a reckoning that would demand choices no one wanted to make. And the next move, by governments, by institutions, by the very people who had built the system, would determine whether the crisis consumed the entire financial landscape or forced the greatest transformation of the era. The breaking point arrived when one of the nation's largest financial institutions announced staggering losses tied to mortgage-backed securities. The revelation confirmed what many had feared but few had dared to say aloud. The crisis was no longer a chain of isolated failures, but a systemic unraveling. Markets plunged within minutes. Liquidity vanished. An illusion that the system could quietly correct itself evaporated in a single, suffocating wave. Emergency meetings unfolded across government buildings and corporate headquarters. Treasury officials pored over balance sheets that revealed gaps too large to ignore. Regulators scrambled to map the connections between failing institutions, only to discover that the risks had multiplied far beyond the reach of their oversight. Private financiers, once confident in their independence, now faced the undeniable reality that no single firm could withstand the tidal force spreading through the system. As losses mounted, the crisis spilled into the global arena. Foreign investors demanded clarity. International markets recoiled. The financial web that had once promised stability now amplified every tremor, sending shockwaves across continents. For the first time, policymakers understood the true scale of the silence that had preceded collapse. Years of unchecked complexity built atop assumptions that no longer held. Back home, the human toll intensified. Foreclosures surged, displacing families who believed they were building a future. Retirement accounts shrank with alarming speed, leaving workers uncertain about the security they had spent decades constructing. Businesses shuttered as credit lines disappeared. The crisis had traveled from abstract derivatives to the most intimate corners of daily life, revealing a profound connection between distant financial decisions and the stability of ordinary households. Government leaders faced an impossible decision: intervene on a historic scale, or allow the market to collapse under its own weight. The debates were fierce, shaped by ideology, fear, and the memory of past failures. Yet the urgency allowed little time for hesitation. Stimulus measures were deployed, rescue packages assembled, liquidity injected into institutions once considered unshakable. These actions were controversial, imperfect, and in many cases unprecedented, but they slowed the freefall just enough to prevent a total systemic breakdown. In the aftermath, the nation confronted the truth with newfound clarity. The crisis had not been born from a single reckless act. It had emerged from years of overlooking warning signs, of allowing complexity to obscure risk, of trusting models more than the fragile realities they tried to predict. The silence had been the danger, and the reckoning became the moment the country resolved not to repeat it. Looking back, the transformation that followed reshaped the financial world. New regulations, new oversight, and a new understanding of how interconnected the system had become. The crisis left scars, but also left lessons etched into the foundations of modern finance. It reminded the nation that resilience is not built in times of calm, but in the aftermath of upheaval, when the cost of ignoring fragility becomes impossible to deny. Sometimes a single revelation forces the world to see itself differently, and from that new perspective, a stronger future begins.